The prevailing sense right now from the market, Tom, is that it's expecting that 75 basis point hike from the Fed. What's your take on that?
Well, Hannah, thanks for having me. The good news is the peak inflation narrative still holds. We did have our highest CPI print in the month of June. However, the bad news is that upside miss, most recently we saw last week, cemented in a third 75 basis point hike tomorrow. That's emergency level hike range of 75 basis points. It was already expected. So the key moving forward is going to be, what is the guidance in the press conference? Are they going to guide more hawkish, in which case we would see maybe 50 basis points more in November and also December, or potentially more data dependent, which might lead to 50 and then 25. So the market may trade a little choppy for the next day or so until people can get through this, what's expected, see the guidance, and then refocus on fundamentals. And business fundamentals have stayed pretty strong, Hannah. Earnings expectations for the S&P 500 have only come down 2.5% in the last quarter. Many analysts were expecting much higher than that. 5-year inflation break-evens. This is the most important thing that the Fed is focused on, more so than current inflation, is expectations, because that affects behavior. Those have plummeted. Today we're at 2.44%, down from 3.59% just in March. That's the lowest in 12 months. So their talking hawkish has worked effectively to bring down demand, to bring down inflation expectations. And the last 6 times that inflation peaked above 6%, which happened in June in the United States, the stock market bottom was already in. So we'll wait and see if those June lows are going to hold in the S&P 500 moving forward, if it's anything like history.
See, Thomas, should we dismiss all this talk about a global recession, or is there still possibility that we could see the globe plunge when it comes to economics at the moment?
Yeah, well, if you look at the Bank of America Global Fund Manager Survey from last week, it's about 200 managers with $600 billion under management. We have the highest expectations for a recession since April of 2020 and March of 2009. That's the bad news. The good news is, in both of those cases, the bottom in the stock market was already in March of 2020 and in March of 2009. So I think there's a lot of pessimism. So any good news could be very positive. We may have already had a recession in the United States. We had 2 quarters of negative GDP growth in Q1 and Q2. The Atlanta Fed GDP now tracker is now at 0.3% for Q3 and trending down. So we could have our 3rd quarter, in which case the recession may effectively be in the rearview mirror. On a global basis, the countries that rely on the kindness of strangers, especially when it comes to energy, will face the greatest slowdown. And I think Europe is the most vulnerable to a recession. Now, as it relates to China, I think people are underestimating, and market participants are dramatically underestimating, the impact of the stimulatory that the government has been pumping out since March. While the rest of the world has been tightening, China has been aggressively easing. And I think we're going to see the effect of that felt as COVID winds down, as the lockdowns wind down, and as the zero COVID policy winds down. Once the country's reopened, like we saw some of the recent economic data in August, I think we're going to really see a boom in China, and that could potentially help the rest of the world that has been in tightening policy, like Europe, like the United States, and all the continents. So we're relatively positive that Chinese stimulus is going to come to bear in the 3rd and 4th quarter and help the global economy.
Thomas, I want to talk a little bit about U.S. housing. Commentary around that is that it's still looking good at the moment. If it is, how long would it be able to withstand the economic pressure that's happening?
Yeah, well, we did have new home construction beat estimates today at 1.5 million units versus 1.45 estimated, but the building permits missed. So they came in at 1.52 versus 1.63 estimated. What we have here, we do think there's going to be an opportunity in housing. That the home building stocks have been trading down tremendously. We've got 72 million millennials in the United States, average age 31, which is at housing and family formation age, and we have an undersupply of 3.8 million units still. So there is an opportunity, particularly for the small size starter homes. We have supply of the bigger houses, but we need the new construction of the small houses moving forward. We have some stocks like Lennar is one that we've got our eye on. We haven't initiated any positions yet, but that's trading at just 5 times next year's earnings. So I do think a lot of the tightening is getting close to priced in. And as rates moderate and people get a little bit more comfortable, I think the demand on the starter side is going to happen from those early 30s starting new families, and there will be an opportunity when you look 1 to 3 years out for these stocks that have really taken a beating this year.
A lot of pessimism in the market, Tom, but what was really nice to see today was, well, for Africa, though, emerging markets here, when I just looked at our major bourses, Egypt, Nigeria, Kenya, and South Africa, they were all in the green and doing quite well. So I was hoping that you were going to say that there is some value in emerging markets. But just really quickly, Thomas, where are you seeing value in the market right now?
Well, you read my mind, Hannah. I think emerging markets is going to be one of the most tremendous opportunities for the next 1 to 3 years. The reason they haven't really taken off just yet is because the dollar is so strong on the tightening fears. I think as the market has priced in much of what's to come in terms of tightening, the trigger to enter emerging markets aggressively is going to see when you see a stabilization in the US dollar, when it stops going up or even starts to come down a bit. And that could come sooner than people expect, depending on the guidance of tomorrow's Fed meeting. Once you see that dollar stop going up, emerging markets are going to be a huge opportunity. They've underperformed. It's the worst underperformance relative to the US markets in 20 years. And that was the beginning of a 5-year run from 2002 to 2007. We think we're going to see similar situation in emerging markets. In China, one of our bigger positions is Alibaba. We think that's a tremendous opportunity moving forward as those factors in China unwind. It's a stimulative economy, an easing economy, and we think we're going to see great opportunities. So just watch that dollar. Once you see a little weakness, I think emerging markets are going to take off, and it's a place to be for the next 3, 4, 5 years.